Assalamualaikum and good day everyone. My name is Miss Basira and today's topic is taxation for trust. These materials are prepared based on chapter 10 in your textbook and we are looking at section 61 of Income Tax Act 1967. So let us explore these topics together. Before we go into details, let's look at learning outcome first. We have altogether 6 outcomes to be achieved at the end of this topic. First, you should be able to determine the resident status of a trust body. Next, we are going to learn on how to compute the distributable and total income of a trust body. Following this, we're going to discuss on how to distinguish the difference between types of trust. Types of trust, here we have 3. We have accumulation trust. Second type of trust, we have non-discretionary trust. And the third type of trust, we have discretionary trust. So we are going to look at into each of these in details later. The fourth outcome for this topic is you should be able to compute statutory income of beneficiary from trust body. So we have beneficiaries who get the income from trust body. That income is also subject to tax. How do we compute tax for beneficiary? Next one, we are going to look at on the application of section 61 subsection 2 and its implications on tax liability. So for this one, we are specifically discuss on the distribution made to beneficiary. Is it deductible or not? Everything will be referring to section 61 subsection 2. And what more important is how this application will affect the tax liability of the trust body as well as for the beneficiary. Last but not least, the outcome for this chapter is we are going to compute the income tax for trust body and the beneficiaries. Alright, as for the introduction, what is trust? It is a relationship where property is transferred by one party, we call it as the settlor, to be held by another party, which is we will call it as trustees, for the benefit of a third party. So the third party here is the beneficiaries. Trust is created by a trust deed, where individual transfers his property for the benefit of his beneficiaries. So to make it simpler, here I have an individual. We call this one as a settlor. The settlor here, he has a trust properties. So we have here properties, and this settlor wants to transfer these properties here to his beneficiaries. So we have here is beneficiaries. However, this settlor do not want to transfer the properties directly to his beneficiaries. What he did is he want to create a trust here. Therefore, the trustee will hold the properties and generate more income. After that, the income from the trust will be allocated to the beneficiaries. Okay, here the trustees are the legal owner of the trust property and they are responsible for administering the affairs of the trust. Before the trust properties being allocated or being distributed to the beneficiaries, The trustee here will be the legal owner, which means that the trustee are responsible to invest the trust asset. He need to account for transactions related to trust asset and reports all the transactions to the beneficiary, as well as the trustees also need to be accountable to file tax return on behalf of the trust. And for tax purpose, the trustees would be treated as a chargeable person under the Act. In this slide, I would like to show you the relationship between the deceased person, executors, and the trustees. It is a relationship between what you have learned in chapter 1 before and what we are going to learn in this chapter. So here we have an individual, which is the taxpayer. From the point A here up until point P here, all the affairs related to the estates of the deceased person will be administered by the executors here, this one. So the period of administrations for an executor started from the date of death until the last date he distributes all the wealth from the estate to the beneficiaries. So here is the last date of administration for an executors. There are situations whereby the executors, when he distributes the income, the residue of income to the beneficiaries, they decided to create a trust. So when there is a creation of trust, chargeable person who is responsible to manage all the affairs with regard to the trust body, we call it as a trustee here, this one. Sometimes the executors and the trustee can be a similar person, orang yang sama. There are other situations where the executors have done his job. After that, the settler will appoint another person to become his trustee. So in this diagram, you can see the relationship between deceased person, executors, and the trustee. Next, let's look at on how we determine the resident status of a trust body. A trust body is deemed resident in Malaysia. For the basis here, for a YA, if any trustee members of the trust is resident in Malaysia. Meanwhile, if none of the trustees are resident in Malaysia, the trust is considered as non-resident for tax purpose. A trust is also deemed non-resident if all the following conditions, these 4 conditions, are fulfilled. First one, the trust was created outside Malaysia by an individual who at that time was not a Malaysian citizen, and its income for the relevant basis year is derived entirely from sources outside Malaysia, and the administrations for the whole of the basis year is done outside Malaysia, and the last condition is at least half of the trustees are not resident in Malaysia. If the trust body fulfill all these 4 conditions, the trust body is also considered as non-resident. Section relevant for trust is section 61. So everything with regard to taxation for trust, we are going to refer in section 61 in Income Tax Act 1967. So how do trusts being taxed in Malaysia? What are tax treatment for trust body? For tax purpose, trust body in Malaysia is subject to tax on any income accruing in or derived from Malaysia. So we know that from YA 2004, foreign source income received by trust, regardless whether the trust is resident or not, is tax exempted. A trust is subject to tax at a flat rate of 24%. So here we have a fixed rate or flat rate for a trust body, which is 24%. Revenue expenses that are deductible in computing the chargeable income of a trust are those expenses wholly and exclusively incurred in the production of income. So the treatment for expenses is quite similar to any business or corporation, whereby if the expenses incurred wholly and exclusively uh, in the production of the income, therefore that expenses is allowed to be deducted. Meanwhile, expenses such as administrative nature, for example, the remuneration of trustees, are not deductible. The reason why? Because this remuneration is being paid after the receipt of income. It is not incurred directly in the production of business income. Therefore, remuneration of trustees and administrative expenses are not deductible. Here in this slide is the computation format for a trust body or a trustee. We're going to start with section 4A, business income, and then you list up everything that trust receive from investment, such as interest and dividend under section 4C. And if the trust receive rental income, you will put it under section 4D, rental income. Add these three together, we can determine the aggregate income for a trust body. From aggregate income, to arrive at total or chargeable income, we are going to deduct annuity payable. Annuity payable is deductible, less approved donation. So here you have to remember, donation need to be approved. It need to be in term of cash, and they will restricted to 10% of aggregate income. Less trustees fee. Trustees fee is not deductible, so we're going to put it as nil. Another one, less distribution to beneficiaries. Distribution to beneficiaries are not an annuity. It is not deductible, so put it as nil as well. Then you reach at total or chargeable income. So here, when we have the chargeable income for a trust body, what we need to do, just multiply with 24%, then we get the income tax payable for the trust body. This one here, the last one, the income tax payable. There is no need to decide whether to use scale rate or flat rate, because trust body will be taxed at a fixed rate of 24%. So if you can see here, the computation format for a trust body or trustee is quite simple. It's quite similar to what we do in chapter 1, just that here from total income, we are not going to deduct any relief, because trust body is not entitled to any relief. Therefore, the total income will be the chargeable income. Next, let's us refresh a bit on how do we treat expenses. So here, a trust body is treated as deriving income from many sources. So income for trust body can come from section 4A, business income. We also have section 4C, investment income, which are interest and dividend. And trust can get income from rental, which is section 4D. What about expenses? So here we have annuity versus distribution. Annuity payable is deductible, while distribution made to the beneficiary is not deductible. Another thing that you need to remember is the remuneration for trustees, salary paid to the trustees. Where trustees is paid for the administration of the trust, his remuneration is not deductible. However, if the trustee involved directly in carrying on the business, which means that the trustee admin the business of the trust, the remuneration for that trustees would be deductible. So here, the treatment for these expenses are quite similar with what we did in Chapter 1, Estate under Administration.